Happy St. Patrick's Day. So green and white for St. Patrick's Day. Also money. And you know how you can make money? Investing in real estate. Maybe you can make money. That's what I'm talking about today. Stick around. Hi, welcome back. My name's Joe Brown, and I'm an agent with Century 21 List with Beggins, located in South Tampa. Thank you so much for being here with me today. So last week, I told you stick around for this week because I'm going to talk about investing in real estate. And I am working with buyers who've said, Joe, I'm looking for investment properties. And I'll tell you, it's very difficult right now, and I'll talk about that in a little bit. One thing I have not shared on my videos is I am a commercial specialist, and I work with businesses and investors who want to buy businesses. I am not talking about that today, okay? I'm not talking about the triple net lease or land lease or anything like that. My focus today is really going to be on single-family homes and duplexes, okay? So if you're interested in the commercial aspect, reach out to me, go to my website, contact me, and I'll be glad to sit down to talk more specifically about your needs. So just in general, now I will tell you that throughout this, I'll throw graphics up here, and I may or may not refer to them. But think about why invest in real estate? Why invest in anything? Whether it's real estate or stocks or Bitcoin, why? Because you expect that money to grow and to appreciate. And you appreciate when it grows, don't you? So there are two ways to make money in real estate. First way is through cash flow. So you buy a property, rent it out, and you get the cash flow from it. Second way is through the appreciation. And the hope is that the value of the home increases over time. So when you go to sell it, you make a profit from the sell, and that adds to your total return. So let's think about this. The way you make money for cash flow is at the end of the month, you have to have more money coming in than going out. So think about what expenses you would have related to a home. So number one, so there's two ways, right? You can pay cash for a home, or you can take a loan on the home. And so you have the principal and interest on that loan. So that's one of the expenses you have. The monthly expense is the principal and interest. But then you're also going to have property tax on top of that. And because it's a rental property, you cannot put exemptions on it. Okay, homestead exemption, that's primary residence. So you have property tax. You also have to have insurance on the house. So that's an expense. There's something called CapEx, capital expenditures. Because you own the home, if the roof leaks, you have to fix the roof. If appliances leak, you have to fix the appliances, right? So those are the capital expenditures that you, listen, you may own the home for 5 years and you never have to touch any of that capital expenditure. But because you own the home, you have to prepare for it, okay? And so the way many investors do is they allocate a part each month towards capital expenditures. So if something comes up, they'll be able to fix it. Another expense is property management fees. Now, I want to spend some time talking about this because some people say, oh, I'll do it myself. Well, first of all, do you have time to do it yourself? Do you want? I call it hassle. Maybe hassle is not the right word, but you are responsible when the tenant calls all the time. But another important that is very, very critical. You could violate the law because of fair housing, right? Because if people say, hey, we want to rent our house, and you say, not to you, that's a violation, and you could be charged. So if it were me buying a property, I would absolutely use a property management company. And there are many, many property management companies out there. So then you look at infrastructure. There's one I would recommend. I'm not going to mention it here. If you're interested, reach out to me and I'll share their name with you. But right now they have like 1,400 homes, properties that they're managing. What that means is they have a built-in system to handle the calls and to handle the situations. They have that system in place. Whereas if people are just starting up, you don't know what kind of system they have. You don't know what kind of support. So again, property management fees, it's up to you whether you use it or not. I would be safe and say, yes, I want that property management fee. But if you use a property management company, just know you're going to have that monthly expense added to the other expenses. So I have an example I want to show you, and I will reference this. So let's say you find a house for $300,000. But you can't find houses for $300,000. And because it's a rental property, you have to put at least 20% down. So in this case, $60,000 down, which means you take a loan for $240,000. Well, if you can get an interest rate at 7%, there's a lot of ifs, right? If you can get an interest rate at 7% for 30 years, then your principal and interest is about $1,600 a month. You have, again, it depends what part of town, what county you're in, but let's say Hillsborough County, taxes are about $4,800 a year, $5,000 a year, so that's about $400 a month. Insurance, and insurance costs keep going up. But let's say you can get a policy for $2,400 a year. That adds $200 a month. So right there is $2,200 a month in expenses. Well, let's say you can rent this house for $2,500 a month. And I'm going to talk about that in a second. But let's say you can rent this house for $2,500 a month. That means your cash flow is $300 per month. Well, remember, out of that, you have to account for a couple things. One, property management fee. Number two, you're going to have to pay your your income tax on this additional income. But then three, you have to set aside part of that $300 for capital expenditures. So it could very well be at the end of the month, you're break even, right? You have made no money. And that's on a month-to-month basis. I've heard people say, well, at the end of the month, I will increase rent. You can, and so how much do you increase it? 1%, 5%? I've heard a friend of mine has different rental properties, and he just increases it $25 a month. That's all, $2,500 a month. The property still keeps appreciating, and he has $25 extra per month. Now, insurance may have gone up more than that. Taxes may have gone up more than that. So those are all variables you have to factor in. Let me talk about rent for a second. So in this example, you find a home, $300,000 home, and you know just to have positive cash flow, you need to charge $2,500 rent. But what if I told you all the homes in that neighborhood rent for $1,800 a month? So if you put your home on the market for $2,500 a month, are you going to have many takers if all the other homes are $1,800 a month? Probably not. But what's the reverse? Let's say the entire neighborhood is renting for $3,000 a month and you charge $2,500 a month. Well, people would come to your house quicker than they would the other houses. Or you can charge more rent. So it's just not a matter of, oh, I'll buy this house, what are my expenses? That's the rent I'll charge. Because you have to also look at the neighborhood. And can the neighborhood support the rent that you're going to charge? So it's not as simple as, oh, I want to buy this house and rent it out. You have to look at a variety of factors and expenses. Here's a second consideration, or another consideration. You put $60,000 down towards this house. Now, you can certainly increase that. Let's say you put 50% down, so you put $150,000 down. Well, what that does automatically is reduces your principal and interest that you have to pay every month. So your positive cash flow at the end of the month is larger. And you say, that's good. Well, think about this. You have $150,000 tied up with this house. What if you put that $150,000 into a CD right now at today's rates? You get about a 4% return, right? So can you get a 4% return in the positive cash flow? So in investments, you look at overall rate of return, but also cash on cash return. So how much cash flow am I getting for the money I have invested? And I happen to run some numbers on this example at $60,000 down. When you sell the property after 5 years, and let's say you sell it for $310,000, and that's accounting for 1% growth each year, then your internal rate of return is 3.5% over the 5 years, right? So from an investor standpoint, you know what? I can get a better return putting the money in the bank right now. And you know what? That's exactly what the Fed wants right now. They don't want people spending money. They want people put their money in the bank, get this money out of circulation. So with all this being said, am I saying that property or real estate is not a good investment right now? Not at all. It depends, first of all, how much free cash do you have to purchase a house? Because yes, that lowers your debt service. What type of patience do you have for the appreciation of the home? So go back to 2020 when COVID hit. Mortgage rates went below 3%. So mortgage rates were below 3%. Interest was below 1% at banks. And companies and individuals were buying homes and renting and getting 5-6% return on their cash. Well, and homes appreciated 30%. Well, really 60% over those 2 years. So the home appreciation really accelerated since COVID. Right now, home appreciation has stabilized. It may go up, it may go down. It's certainly not going up as quickly as it did. So for home appreciation, you just have to be patient. So the big question is, if you want to invest in real estate, do you have the money, the cash on hand to put down? And second, do you have the patience to wait for the market to start picking up to where maybe it's not a 1% appreciation each year, maybe it's a 2% or a 3%, right? So I know I gave a lot of facts and figures. Listen, I understand what I'm talking about. I may not have communicated that well, but I know what I'm talking about. So if you have questions, please reach out to me. Leave a comment below. Go to my website, Joe Brown C21. Send me a message. Listen, there are properties out there that could be worth investing, but it's really a tight market. I will tell you if you're interested. So listen, this Tampa area, so Tampa, Lutz, Wesley Chapel, that is a saturated market. So to really look for opportunities, you need to look outside of that. So go up to Brooksville, San Antonio, over to Winter Haven, out in that area, even further south of Palmetto, even south from Palmetto, Bradenton, Sarasota. That's a pretty hefty market too. That's saturated. So there are markets available, right? But you just have to be willing to think outside the box and go outside of the Tampa area. Anyway, I hope this was informational for you. Well, it was information. I hope it was informative for you. If you have questions, send me an email. I love sharing this information with you because South Tampa, Florida living is awesome.